Let's just start off talking about some of the comments that we got from Powell yesterday. A focus on the softening the labor market. It was just discussing that with Jill. Did you learn anything new as a market participant? Did you walk away feeling more vindicated about your own call for further rate cuts this year, or the beginning of rate cuts this year?
Jumana, not really, because this started 1 month ago during the meeting that the Fed had, where Chair Powell has said that jobs are being overstated or overestimated. I forgot the exact word. That was very revealing that he bring this up. So last night saying what he said was absolutely not surprising. If you look at full-time jobs, they are dropping like a rock, despite payrolls going up, but full-time jobs are dropping. And this is really concerning. The U.S. typically, economically, things go slowly, and then very quickly. And I think this is exactly what Chair Powell wants to avoid.
And we've spoken about this in the past, and you think that perhaps the Fed are keeping rates too tight for too long. They're at the risk of not cutting quickly enough. To what extent do you think that is going to become more apparent we've spoken about the labor market, but in the inflation data? Because last week at Sintra, Powell suggested that they're not expecting to see inflation hit 2% in 2024.
Yes, absolutely. This will take time, clearly, because the last mile is always the most difficult with inflation. And this is where usually inflation, when it goes very close to 10% and then drops back again, usually we have a second cycle of inflation. So it's self-fulfilling. And this is what I think Chair Powell wants to avoid as well, which is a second cycle of inflation, as we have seen typically in the U.S. So today, that's why they're very careful. But at the same time, they do not want the jobs market to collapse, unemployment to spike up, because this is when we have a hard landing. And let's remember that this is precisely what the Fed wants to avoid. They want a soft landing and get as close as possible to 2%.
Yeah, not that markets seem to care. Our terminal chart today is quite demonstrative of the fact that S&P keeps climbing to record highs, despite the fact that some of the data has started to soften. I was looking at the numbers for the first half of the year. 60% of the performance of the S&P has been driven by the Magnificent Seven. Is that going to continue, Ryan, into the second half of this year?
Clearly, it's going to continue. The concern here, because it's mainly driven by AI, and all of the spending that is going into AI, we do not yet see a product that will bring that revenue to justify all of the spending. So if you look just ballpark figure, we will need roughly $600 billion of revenue to justify all of the spending going into GPUs and data centers. And at the moment, you have OpenAI, which is the biggest, and they're bringing $3.4 billion in revenue. So we don't yet see the product there. However, speculatively, yes, we expect it to continue as long as things are holding up as they are at the moment.
Well, we've got earnings season. It always comes around faster than you think it's coming, but it's starting again this week with the U.S. Wall Street banks. Is there anything you're watching out for that you think could impact the direction of travel for stock markets from here, given so much of it now is concentrated in the hands of Magnificent Seven?
Yeah, the concern for us are banks. So we do expect a shrinkage in revenue of 10% rather than growth. This is on the basis of net interest income reaching an inflection point and starting to drop. So banks have done very well with NIIs. However, now there's an inflection point and it's starting to drop. Second, loan growth has been quite sluggish, and understandably so, because credit conditions are quite tight. They haven't relaxed them, which is a very good thing. So we do expect banks to start making less money and even shrink in revenue. Let's hope we don't see any collapses in banks, specifically regional banks, because this, I think, can spoil the party for AI.
Well, we said the same about a year ago, and that didn't seem to spoil much of the party if you rewind back to those days when U.S. regional banks were looking a little precarious. Ryan, final quick one for you. I see still from your asset allocation that you're sitting at around 30% cash. Given your very strong views on the U.S. economy and the fact that the Fed will probably have to start this rate cutting cycle soon, are you thinking about increasing your cash holdings, perhaps as a defensive play into the end of the year?
For now, the cash position is bringing quite a bit of return because they are mostly in fixed deposits and we're earning 5 to 6% in these. And this is smoothing the portfolio volatility and giving us a bigger risk budget to allocate to risk assets elsewhere other than the US, namely India, China, Japan, and a few other countries. So for now, the cash position will remain stable.